dive into a currency trading strategy that sounds fancy, but is surprisingly straightforward. The carry trade. Stick with me and I'll break it down step by step. Let's go. At its core, the carry trade is simple. You borrow money in a currency with a low interest rate and invest it in a currency with a higher interest rate. The difference between those rates? That's called the carry, hence the name. And it's where your profit comes from. For example, imagine borrowing in Japan, where interest rates have been historically low, and investing in Australia, where rates are higher. That difference is your reward. This works because different countries have different economic goals. Japan has often kept its rates low to boost growth, while countries like Australia or New Zealand may use higher rates to manage inflation. These differences create opportunities for traders to earn. Here's how it plays out. Say you borrow 1 million yen in Japan at nearly 0% interest. You convert it to US dollars and buy US Treasury bonds, yielding 3%. While your loan costs almost nothing, you're earning 3% on your US investment. That's your carry. Pretty sweet, right? But it's not all smooth sailing. Here are some risks. Exchange rates. If the yen suddenly strengthens against the dollar, you'd need more dollars to repay your yen loan. That could wipe out your profits or even cause a loss. Interest rate changes. If Japan hikes its rates or the US lowers theirs, your profit margin shrinks or disappears. Economic uncertainty. In tough times, investors might ditch riskier assets, weakening the currency you invested in. This can hit your returns hard. Let's talk about a recent event. On July 31st, 2024, the Bank of Japan raised its key interest rate from 0.1% to 0.25%, aiming to curb the yen's slide against the US dollar. This move made borrowing in yen more expensive. Combine that with a weaker US jobs report, and investors started to panic. Many began selling their riskier assets, converting them to yen and paying back the loans. This caused the yen to strengthen even more, and it created a vicious cycle called the unwinding of carry trades. Thankfully, the Bank of Japan calmed the markets, but it's a reminder of how tightly connected global markets are now. So that's the carry trade, a strategy that takes advantage of interest rate differences but comes with its risks. If you're curious, take your time to learn the ropes before diving in. Globalization has given us some incredible opportunities, but as we've seen, even small changes in one country can send shockwaves around the world. I mean, who'd have thought that the Bank of Japan slightly raising their interest rates could cause the US economy to have a full-blown identity crisis? So just stay informed and trade wisely.